Hey, welcome everybody. I think we got a good topic today. North American natural gas market, especially we're going to focus on the Western Canadian market. Uh, this webinar is being hosted by Pine Cliff Energy. They're an upstream oil and gas company with operations in Western Canada, which was recently referred to me by one of our members up in Calgary. Pine Cliff looks very promising to me because I'm bullish on natural gas prices in Western Canada. Pine Cliff reported Q1 2025 production of 21,283 BOE per day. That's barrel of oil equivalent, with a mix of 79% natural gas, 14% NGLs, and 7% crude oil. The company's current production is over 22,000 BOE per day, so pretty decent sized company. Joining me today is Philip Hodge, the company's president and CEO. Philip joined Pine Cliff in January of 2012 as president, chief executive officer, and director. He was actually, I know on their website, he was the first employee of Pine Cliff. He held the positions of vice president, business development, and vice president, acquisitions and divestitures at Penn West Exploration, which is one of the largest conventional oil and natural gas producers in North America. Joining Philip today on the call will be Terry McNeil, the company's Chief Operating Officer, and Austin Neudorf, the company's VP Finance and its controller. So Pine Cliff has grown primarily through acquisitions, but it now has a lot of high quality running room in the Western Canadian Sedimentary Basin. My take on the natural gas prices in Western Canada is that Q2 will be the lowest average AECO natural gas price of the year. You had wildfires in Western Canada that shut in some of the demand of the heavy oil projects in Western Canada, and that demand is back online. And then you've got LNG Canada, a big export facility, ramping up exports now. The Canadian gas market will tighten up in the second half of 2025, and natural gas and NGL prices in Canada should move much higher in 2026. At least that's our hope. So during the webinar, if you have any questions, please type them into the chat box and we'll answer them after the presentation. With that, I will now turn it over to Philip for an update on the outlook for natural gas price in Western Canada and Pine Cliff Energy's plans for 2025.
Thank you very much, Dan, and thanks everybody for joining us this morning, or whenever you're going to be listening to it. Let me just see. Can you see the presentation okay there? Perfect. So Dan gave you a bit of background on myself and on Pine Cliff. This is now our 14th year, and when we started with 100 barrels a day of production, and now we're over 21,000 BOE a day. Like he said, we're 79% natural gas. The goal right from the very beginning was to build a dividend-paying company based off natural gas. And as you know, as all the listeners and viewers could, I'm sure, attest, I mean, building a dividend-paying company off of a commodity is not an easy thing to do because we don't control the price of what we sell our product for. And we've seen in the last 14 years, there's been some really good years and there's been some very more challenging years. One of the things that we've seen the cycles, I'm quite bullish about where we're headed. I agree with Dan. I think we're headed into a pretty good time frame for natural gas producers for the next couple of years after having come off a couple leaner years. And we'll talk a little bit about that. One thing I really like about the Pine Cliff model, which is quite unique, and I'll point out why it's unique in a few features, but it's been stress tested against some of the worst gas prices we've seen in 30 years, and we've still made money. Not as much as we'd like in those years, but we still were positive cash flow. And that's, again, the unique, the really low decline, the way we run the operations. We run very lean. We've continued to do, we've done about 15 acquisitions in the last 14 years. The last acquisition we did was a $100 million acquisition in December of 23. And that one we did just with cash and debt. So we haven't issued any equity in 6 years. We're very defensive about our issuing those shares. So the one item that we're quite proud of, especially for a company of our size, is that we've paid out over $100 million of dividends now since 2022. That's when we put the dividend in place. And so that's a pretty impressive number when you're, we've got and all the numbers I give you today are Canadian numbers. I apologize. I'll let you do the conversion. But for a company of our size, it's in that $250, $300 million enterprise value size. That's a lot of dividends to pay out. We've been always focused on the balance sheet. We've gone long periods of time where we've had no debt whatsoever. We'll be down by the end of this year. We look to have our debt to cash flow down to about under 1x, which is, we think, a very comfortable level. But if 26 and 27 are strong years, it's quite possible that we reduce our debt back down to zero again. Why we do that is it puts us in a really strong position for acquisitions. And so we've found over the years that having a low debt position and a strong balance sheet is very helpful when you're negotiating transactions, because quite often they don't want to, this vendor doesn't want to hear subject to financing. They just want to know that you've got the ability to close when they want to close. So that's been very advantageous to us. Dan mentioned it. We've got quite a few U.S. shareholders, and that's why we are listed on the OTC in the U.S., just to give a little bit better access to some of our U.S. shareholders for trading. Canada has not always been an advantageous place to invest on the natural gas side, because our only customer really was the United States. And so there's a couple numbers I'll ask you to remember. One is 18.5 BCF a day. That is how much Canada produces. All of Canada. Almost all that gas production comes from British Columbia and Alberta, those provinces. The province of Saskatchewan has a little bit of gas production, but most of it's from Alberta and BC. Of that 18.5 BCF a day, about half of that goes to the United States every single day. The other, the bit of a trivia question for you is, who's the largest natural gas consumer in North America? And it's our oil sands. So our oil sands use today about 3.6 BCF a day of gas, and that number is going up because they've increased their capacity with the Trans Mountain Pipeline to send more oil out. And so that's a positive. But the big kind of shorter term catalyst here for the next few years is going to be LNG. Canada has never had any LNG exports, and that changed as of last week. So the very first LNG tanker left a small place called Kitimat. It's on the west coast of British Columbia. We'll talk about that. I've got a slide for you. But that's a huge event, and so it'll ramp up. It's going to take a time. We've seen this from the U.S. projects in the Gulf of Mexico. It takes a while to these projects to ramp up. They hope to be up to a BCF a day by the end of this year, and a 1.9 BCF a day by next year. That's 10% of all the production. Going back to that number I just gave you, that's a big number, and that's just phase one. Again, we'll talk about that later. One of the other kind of unique features about Pine Cliff is our biggest shareholder is the biggest pension fund here in the province of Alberta. It's called AIMCO. It's the Alberta Investment Management Company. They manage about $160 billion. They are over 10%. They've been with us now for 9 years. Never sold a share over that period of time. That goes back to our insiders. Myself and a gentleman by the name of George Fink, who is my chairman for 13 of our 14 years. We've never sold a share. I continue to buy more shares. I always have to hold myself back a little bit because we already own a lot of stock, but I'm still convinced that we've got a really good runway here. Our stock price was $1.65 18 months ago when we did the deal. It was well received, the deal we did. But then natural gas prices dropped by 50% within the next 3 months. So our stock price came down, but I'm pretty convinced that we've got the ability and to get that stock price back up again. We've been over $2 a few times in our history, and one thing I can say definitively is that our company's never been as strong as we are today. And from an inventory, and Dan mentioned that. I don't blame anybody for not giving us any credit for our organic inventory, because we haven't been drilling it. We took a 18-month break from drilling because the gas prices were, they averaged $1.50 last year. And they're going to be a little over $2 this year. At those levels, we weren't all that excited about doing drilling. And because of our low decline rate, we didn't have to do the drilling. But we are going to start drilling again this fall. And so we're pretty excited about that, and we'll talk about that. So that's kind of the overall. here's kind of just where our assets are. We're almost all in the province of Alberta, got a little bit in the province of Saskatchewan. I mentioned that, from a market cap standpoint, we're about 250 million. We've got about, as of the Q1, we've got about $44 million of debt. We're paying that down every quarter. So that's, we can keep knocking that down. We've got a good tax pool, so we're not taxable today. We don't expect to be taxable in 26 either. We've got, I think this slide here is a good indication of why we're bullish on what we're doing at Pine Cliff and why, some of the insiders have been buying stock recently. This gray is the AECO price. AECO is think of it as the NYMEX of Western Canada. It's the natural gas price marker. So, when in 2022, it went to about $5. At that, we went from $50 million of debt to $50 million of cash flow in 12 months. We have the highest torque to the AECO than any other Canadian public company on a per share basis. That's pretty important because we think LNG is going to play a really large role in impacting kind of AECO going forward. This isn't just us kind of guessing. You can already see it in the forward strip. So gas prices are already for next year over $3. They're getting close to $3 for this winter. Matter of fact, recently they were over $3. We've had a little bit of softness here just in the last few weeks, but there's a lot of analysts out there that are calling for $4 gas next year. I mean, who knows where we're going to be? I know Dan's got some views on that, but the point is that as gas prices are rising, our cash flow goes up very quickly, and that's what I think a lot of investors are focusing on is what's the free cash flow. And I think that's, frankly, as an investor, that's what I focus on. I mean, here at there's probably never been a time in the last 14 years that we're not looking at something to buy. That's just in our DNA. So we're always looking at things. Quite often we're looking at assets that generate really good cash flow, but they have to spend all that cash flow to generate that cash flow. So they're really not generating any what I call free cash flow after keeping your production. For us, if you're trying to build a really strong dividend model, the free cash flow is that's critical. Just being bigger for the sake of being bigger and generating more cash flow, but if you have to spend it all, that's not really helping the business model. For our standpoint, it's about free cash flow. And so everything we look at is about free cash flow. How do we generate more going forward? And that's what I think the market's really starting to focus on. I know we've been recently upgraded by some of the analysts that cover us because we're in their universe. We have generating some of the highest free cash flow yield of all the companies they're carrying. And then this is from a company called Peters & Co., which is a Canadian investment bank. You can just see how well, how torqued we are to natural gas. And about every 10-cent move in gas prices is for us is about $3.3 million of cash flow. So when you go from gas prices for 25 are going to be around $2, call it 220. If we're at 320, 330 next year, you're talking about $35 million of incremental cash flow for us. That's a big jump. So that's, I think, what you're going to see more and more people focusing on. And now it's hard to believe, but we're already in the back half of 2025. So everybody starts looking at 26 numbers now. And so that's when the Pine Cliff model really starts to stand out. The low production decline is kind of what a lot of people know us as, and that's, we have a base production decline around 9%. The average natural gas company in Canada is about 32%. What that means is that we just don't have to keep drilling if it doesn't make economic sense to keep our production up. So we let our production come down. We really don't, it's all about making money, not about making molecules. And so in 2025, like when we did I mentioned the acquisition we did in end of 2023, we entered into 2024 around that 25,000 BOE a day. So we've let it come down to around 22, but because it just didn't make sense for us to go back to the drill bit. It does now, though. The forward strips now, the prices we're locking in, and we've already hedged prices going forward. So we've already protected our drill program for the back half of this year. We're pretty excited here at Pine Cliff about getting to some of these locations. This area here, this circle, is where we did the asset acquisition. This is what in Alberta they call the Deep Basin area. So two of the big producers in this area are Whitecap and Tourmaline, both of which are drilling very actively in this area and have had really good results from the Glock oil. It's called Glock oil because the oil is driving the economics, but it actually has a substantial amount of gas production as well as part of these wells. They're not inexpensive wells. You know, they're the DC, you know, to drill, complete, and tie in is around $9 million a well. We've already put that money aside for the back half of this year. We're right now anticipating drilling in October of this year and hopefully bringing them on by the end of the year. So we plan to enter 2026 with some new production. This is a very prolific area. So from a hydrocarbon standpoint, the risk is very low. There's always technical risk when you're drilling, but there's you can see all the, you know, there's a lot of well control in the area. We've got, you know, we've spent the last year amassing as many 2-mile locations as possible because you really want to do these wells in 2 miles. And it was a bit of a checkerboard for all of the producers in the area. So there was a lot of swapping to get people to get really good locations so that they could drill 2-mile locations. The economics you see here are 2-mile locations, and these are assuming $60 WTI and $3 gas. And as we already talked about, prices are already over $3 for next year. So, you know, these economics we're hopefully going to be in an environment where we're getting less than 1 year payout on these wells, and they you know, IRRs of over 100%. You know, I think a big part of Pine Cliff is the macro natural gas, and Dan referred to this a little bit, and even before we came on here, we were talking about this. There's a lot of tailwinds right now for natural gas in North America. I think we're in a really prime position, and a lot of people don't realize what's happening on the LNG side, and I've got a couple graphs here that we'll talk about it. But the other thing I always, you know, when I'm talking to my friends in the United States, many people don't realize that 43% of all their electricity comes from natural gas. And then, you know, the second best the source of electricity in the United States is coal and nuclear, both at about 18%. Like natural gas is by far the dominant of electricity. So everything you read, and I'm sure we've all read so much about AI and energy growth and all the energy demand and the grids, you know, all of these things, natural gas is such an important part of that entire conversation. And I think we're seeing that more and more. Luckily for us in North America, we have a lot of natural gas. And in Canada, we've got tremendous amounts of reserves, mainly tied to the Montney and Duvernay and some of the other large natural gas plays up here. And the United States have got some unbelievable, I mean, the Marcellus, the Utica area, the Haynesville, a lot of the associated gas coming out of the Permian. But the demand is really gonna move up here quickly. And I think that's, you know, we're now starting to see that, you know, for many of us who are a little bit older, we remember when the discussion around natural gas was always, what's the weather going to be? How cold is it going to be this winter? How hot is it going to be this summer? It is now a lot of this new demand with data centers, LNG, they're not seasonal. Those are 365, 24/7. And so a lot of that demand is now just coming into the system. This, from a US perspective and from a North American perspective, this might be the most powerful slide in here, this off on the right. The United States had zero LNG exports in 2016. That's not very long ago. And, you know, many know the history that there was actually going to be import facilities, and then they turned them into export facilities at Cheniere. Since then, the United States has gone to become the largest exporter of LNG in the world, larger than Qatar, larger than Australia. But there was a pause. So it ramped up really fast, about 13 BCF a day. And just for context, the United States produces about 105 BCF a day. It might be a little bit lower, a little bit higher at any given time. So it was a pretty significant piece of how much the total production. But there was no new LNG facilities from 2022 to 2024, almost a 2-year hiatus. So it was people got comfortable with the demand. Like I say, remember in 2022, we had really strong gas prices because that was right when a lot of this demand was coming on. But look what's about to happen and is happening. I mean, you can see already that we're almost 2 BCF a day more LNG exports from just last year. What that is the beginning of this hockey stick of LNG that's coming on. Included in there is LNG Canada. So we talked about LNG Canada a little bit. There's a couple other smaller LNG projects up here in Canada too, the Woodfibre and the Cedar LNG. They're all coming off the West Coast. But you can see the Plaquemines, the Corpus Christi. You just recently in the news, Golden Pass is now applied to start to be able to export out of their facility. So these are all coming online. You've got a situation where we're going to be, North America could be exporting about 30 BCF a day, which is 25% of the entire production that we make in North America. Mexico's got an LNG facility that's being built, and they're importing all their natural gas from the United States and Canada, but they're building an LNG. And the reason they are is because they want to take advantage of the same thing Canada has, which is this ability to ship to the Asian markets with only 10 days shipping as opposed to coming out of the Gulf at 24 days. So that's a big competitive advantage for gas that's coming off the West Coast. Unfortunately, I don't think there'll be any LNG facilities built in California, Oregon, or Washington anytime soon. So where they're going to come from? They're going to come from Canada, and they're going to come from Mexico. So the biggest importers of LNG in the world are China, Japan, Korea, and Taiwan. So they're all getting access to that Asian market is very, very key. And so right here is Kitimat, BC. That is where the LNG Canada operations are. This Coastal GasLink pipeline that was built, it's like a $35 billion project, is 100% complete. It has got capacity for 5 BCF a day. That's an important number because the LNG Canada phase 1 is only 1.9 BCF a day, and the smaller Cedar is about 0.4 BCF a day. So highly probable that LNG Canada is going to announce their second phase. We hope this year that they'll go positive FID, which is the final investment decision. If that happens, that's going to be another 2 BCF a day, another 10% of the production out of Canada. And then on top of that, you've got this, what's called Silisma. This is used to be called, some of the people listening may know it as Rockies LNG. They recently changed the name. That's another 2 BCF a day. And then you got the Woodfibre. So Canada could be exporting up to 6 BCF a day of LNGs by the end of this decade, like in the next 5 years. That's, again, keep in mind, we only make, today, we only are making around 18.5 to 19 BCF a day. So that'd be a third of all of our gas production. So this is new to us. This is new to Canada. What's that going to do to AECO? What's it going to do to the domestic natural gas market? We're all speculating because we've never had the LNG. We've seen examples of this though in both the United States, where gas prices have gone up around in the Louisiana and in the southeast United States because of the LNG demand. We saw this in Australia. Australia, probably a better metaphor or analogy to Canada because of the resource based and becoming an exporter. Their prices went over to $10. They actually had to put a domestic cap on their natural gas prices because of the LNG demand was taking so much of the gas out. The second, and this is becoming really topical, and a lot of the listeners to this webinar probably know more about this than I do, but this data center growth and the energy growth is real. The amount of new data centers that are being built. We're very fortunate here in Alberta that our province is doing everything they can to attract data center investment into our jurisdiction because of the natural gas we have, and because of we're actually being a colder climate is actually an advantage for a lot of these data centers. And so we're going to see growth here in our own. Pine Cliff's one of the only companies that I know of that's announced a data center deal. We announced that in January. We hope to be able to give you more details on that as construction gets going. But that's significant to us because in that case, we were able to negotiate a supply contract that's tied to NYMEX pricing, not AECO pricing. And that's key because it doesn't have any transportation costs. Typically, it costs about $1 an MCF to send gas across the continent. So that's, when you think about differential, when you think about NYMEX pricing, right now there's a wide differential between AECO and NYMEX. I suspect that's going to tighten up as we go through and as LNG Canada comes on, to back into hopefully into that probably that dollar range, which is which is roughly what the cost of transportation is. But this data center growth, we're watching it really closely. We've had lots of discussions with lots of different companies because we've got many sites that could be very good locations for something like this. And as you know, this is from the Antera folks. That's another 7 BCF a day of natural gas demand that they're expecting on top of the LNG, on top of the Mexico exports. By the way, where I didn't even touch on that, the United States sends about 6 to 7 BCF a day of gas down into Mexico. So it is, it's a interesting, right now. I've told this to a few of our investors. It's such a unique time right now here in the summer of 25 because gas prices are quite in Western Canada are quite weak. We're just over $1 an MCF today. That's not a sustainable price. And yet things are so good just a few months from now. Like this fourth quarter of this year, we've already locked in prices at over $3. So we've kind of just have to kind of grind through the summer months, and then things start looking a lot better. One of the reasons why prices are a little weak right now is because we had a supply bump here in Western Canada as producers got ready for LNG Canada. They wanted to make sure that they needed the gas production. So you can see where production's higher year over year. The US has been pretty flat, which is an interesting dynamic because Dan and I were talking about this before, is that a lot of this new demand that's going to come from the LNG, they're going to need the gas supply, but a lot of the producers have been very vocal about this, that they're going to need higher gas prices to justify them going back to the drill bit. So rigs have been coming off. And so if you're going to motivate people to go back to drilling, especially in places like the Haynesville, they're going to need better gas prices. And that helps, domestic prices right across North America. Any exports in North America help every other producer. It doesn't even matter if it's in your backyard or not. Any gas leaving the continent obviously reduces supply, and therefore it has a positive impact on cash flows for everybody. For those of you who have been investors in the oil and gas industry over the years, this slide will resonate with you. For years and years, our industry spent more than they actually brought in. That was just the way the business was run. It was all about growth. You could always raise equity as long as you were growing. That's changed. You look at the last 5 years and how much what CapEx is compared to cash flows. Because equity markets have been muted for the energy sector, it's really required companies to focus on return to shareholders, which in the form of either dividends or share buybacks. And so you've got this situation where cash flows now are much stronger than CapEx. And that's healthy, I think. And that's the way Pine Cliff's always been run. We were never in one of these situations where we were outspending our cash flow, but our industry did. I think more and more investors are going to see this. It's going to be tough to, when you're looking for rates of return and looking for free cash flow across all the industries, it's going to be tough to ignore what's going on in the energy sector. And it's particularly, I think, the natural gas sector. This goes to the point I was making about, I call natural gas storage the scoreboard for the oil and gas, for the natural gas industry. If you want to know, who's winning between supply and demand, look to the storage. Right now, storage is in a more bearish view. In Canada here, we're near the top of our 5-year band where we've been at storage. That goes back to the supply I just pointed out. That we've had more supply, therefore storage is higher. But LNG Canada is just starting up. That's a big number. So we're going to have, for the first time ever, we're going to have LNG exports pulling gas out, and that will have an impact on the storage numbers. The United States is in a little better situation. They're a little bit above their 5-year average. Hasn't been quite as hot as it was last year, so there's a little bit more gas in storage. But storage can move really rapidly. I mean, I like this slide over here. We've had almost no new storage built in the last 13 years. And yet supply and demand is much, much larger. And so, the analogy I make is it's like having bigger and bigger engine, but having the same size of gas tank. And so you're now, when you hit the accelerator one way or the other, or you hit the brakes, you're going to have a bigger impact on what storage is. So it's a bit volatile from pricing. I mean, we've just gotten, as an industry, got used to that. But what excites me the most is kind of the LNG markets and what it's doing to natural gas around the world. You've got a situation in Europe where Many of the countries relied on Russian natural gas are now building. Germany's building 5 LNG import terminals. They've never had an import terminal before. Shell and BP and others are predicting we're going to actually have even though despite all of those LNG export facilities that I showed in the previous slides, that they're still calling for there to be a shortage of LNG in 2034. So that's a good thing for a lot of these new LNG projects that are now deciding, are we going to go positive FID? Are we going to put the capital investment to build new export facilities? The markets they need more LNG. Everywhere natural gas is used in the world, it's rising in its use. Coal, still very, very huge proportion of the global energy share, but it's kind of plateaued. It still had its record year last year, but barely. Oil's still growing, but slowed down a lot. Natural gas is the one that continues to rise. And despite the trillions of dollars that have been spent on the renewables, the wind, the solar, the hydro, the geothermal, the reality is that over 80% of all the energy in the world still comes from hydrocarbons. The mixture's shifting a little bit, where natural gas is starting to take market share away from oil and coal, but it's got a really strong future. So those are the reasons why I've been buying more Pine Cliff stock. Maybe Dan, we can open it up to questions from some of your viewers.
Yeah, good stuff. Anyway, I had a bunch of questions that I sent earlier, but I'll read them. We'll go through them, and then if any of you on the call have questions, just please type them into the chat box, and then we'll go.
Oh, Dan, you're muted there.
Okay, I'm bad. Okay. Good stuff. And one thing I want to point out, and I mention this every once in a while on our chat board, looking at comparing gas and storage to the 5-year average, which has always been the case. I mean, this is just typical of everybody that's been in the industry for a long time. That's the thing we look at for where's the gas market over or undersupplied, looking back at the 5-year average. But the thing is, the demand for North American gas is growing so fast, and we don't have enough storage built. I saw an article on that the other day that some people were almost panicking that we don't not have enough storage to build storage high enough to make it through a really cold winter. And because of that, I think we really need to look at where we stand in relationship to storage last year. Because remember, storage, when we began the winter last year, storage was way above the 5-year average. And then, we have a couple cold months, a couple colder than normal ones, and bam, we end the winter. Even though March was very mild, we ended the winter way below the 5-year average. So we should be looking at how storage compares to where it was last year, not the 5-year average, because the 5-year average is looking backward. When you look forward, you're going to keep having more and more gas and storage at the beginning of each winter to make it through.
I agree with that.
And I think that's good, that when that paradigm shift on how we look at the market comes in, I think it's going to be a big deal for where gas prices go. Anyway, so here's some questions. So Pine Cliff paid down term debt in the first quarter. Have you paid down debt in the second quarter? And can you tell us how much? Or
yeah, so we're paying down over $1 million every quarter. So we did a double payment in March. We've got so we're as of the end of March, we're about $44 million of term debt. We'll pay down every quarter, paying down $1 million. We've got the ability to accelerate that in 26. So that, when you talk about all the free cash flow that we're generating, I'm looking forward to the capital allocation discussion in 26, because it'll be, okay, do we raise the dividend again? I mean, our dividend we put in place in 22, we've raised it twice and lowered it twice. We lowered it the last time in March of 25. The reason we lowered it is I wanted to free up cash flow for the drilling program and make sure it's fully funded for the back half of this year. So we took that from the dividend rather than issuing equity. And I have, like say, I think I mentioned earlier, we haven't issued equity since 2019. So it's been almost 6 years since we've issued any stock. Very, very protective about our stock. But so, yeah, we'll keep paying down the debt. We've got, if we're in a really strong free cash flow position next year, maybe we accelerate that and we pay down the debt even faster. That's a possibility.
So you're paying monthly dividends, correct?
We are, yes.
And then what are they now? And so what's the annual yield right now?
Yeah, so it's a little over 2%, 2.3%. Some, I think around there is our yield. It's a 1.5 cents per share annually. And so then divided that across on a monthly basis. Shareholders really like the monthly dividend. I know my wife does, but
We
it,
do too. We do like them too.
it's nice to have that kind of coming in and reminding why you own the stock. And like I said, that again, I come back to that number that the fact that we've paid $100 million in dividends for a company of our size, that I don't know if there's any other companies. I'm sure one of your listeners will point out somebody who has, but there's not many companies our size who have paid that much dividends in the last 3 years.
Yeah. Yeah, that's good. And I agree, cutting back on the dividend this year to build up the cash so you can fund your entire drilling program. That's the way to go, really. Hey, let me ask you this. How has Pine Cliff, I mean, I was very impressed when I first looked at your low decline rate. So how have you achieved that? Did you just, the properties you acquired were all, pretty mature, so they had kind of flat production, or?
That's exactly right, Dan. I mean, for the first 8 years, I'd say, of Pine Cliff, we really focused on the legacy, longer life assets, and as you said, where the flush production had already left these assets. But they continue to, they've been operating for decades, and they'll continue to pay for operate for decades longer. That was the focus. I'd say the last 5 years, 5 years anyways, our assets that we've purchased have not been of that nature. They've been more conventional with more drilling inventory. We are very conscious of the fact that even though we had a low decline rate, it was still a decline rate. So we needed to add some really strong drilling inventory. That last deal we did, we're very proud of that deal. And it kind of filled that void of giving us some really quality inventory to deploy capital. So some of our growth in the future is going to be organic, whereas in the past it's almost all been by acquisition. So yeah, ironically, and this ties into the data center discussion, some of those low decline assets that were kind of legacy, they were kind of not as exciting because they don't have the same drilling upside. Those are the exact assets that Bitcoin and data centers want, because it's got really predictable production for decades to come.
Mhm.
That's what they want to see. And they don't want to have a bunch of liquids in there. They want a very pure methane for their engines that they use that generate the power. So we're having a lot of discussions now around those assets that we purchased early on that helped set that low decline base.
Yeah, good. There I get a lot of comments sent to me that they say, "Oh, I've heard this AI data center stuff, but there's not enough turbine. There's a shortage or backlog of these big turbines that are in the gas-fired power plants." But the one thing I like to say is, down here in Texas, we have a bunch of natural gas-fired power plants that pretty much only run in the summer because
Right.
of demand for air conditioning electricity.
Yeah.
Um, but the thing is, those can run all year.
Yeah.
And so there is demand from those plants, because if demand for electricity picks up high enough, they'll just run those plants all year.
Yeah. It's an
So
interesting that,
different way to
Dan,
look
because
at it.
yeah, one of the things that we've, in the many discussions we've had, the we've talked to the Bitcoin guys over the years, and we've talked to the data centers. The Bitcoin, they don't like it if your operations, if they lose their power, if it has to go down, but it doesn't kill their business. It's just that they're not mining anymore. The data centers, though,
Yeah.
they talk about the 5.9 of reliability, like they need it on 99.999. And so that's where wind and solar don't work for the data centers, because they can't deal with intermittent power. And so they may be involved, but you're still going to have to have a base, which is again why this whole data center surge is really going to have a big impact on natural gas demand.
Yeah, when the AI data center, when this whole demand increase, how much electricity they're going to need, immediately I saw all these people posting, "Well, we'll just build more windmills and more solar." I said, total baloney. They are not going to hook up to wind and solar,
Yes.
period.
Yeah.
They must have, and that's why they want to have their own power plants that they can control. I don't know if you personally have you heard about that Stargate project in Abilene,
Yes.
Texas? Yeah, I just thought they were talking about it.
Yeah.
They are out there building. Okay, they've got half the power plant already built now, and they're
It
going to build these power plants where the gas supply is, because they don't want to rely on the grid to
that's
get.
that I was just going to make that point. It's that's the next new, how any story, it starts to get more as you go along, you get more and more into the details. We're seeing that up here too, is that at first it's like, oh, come on, everybody, but you know, every jurisdiction would love the tax base of having more data centers in their jurisdiction. And the United States leads the world in data centers by a long shot. But the problem is the grid, is that you just can't come and just because the grids are already maxed just about everywhere. So this, you're absolutely right, Dan. The solution to that is to go what they call behind the fence, so that you're off the grid. You don't need the grid. You're now, so you have gas supply coming into power generation and you generate your own power. Those are the projects that we're looking at getting involved in.
Yeah. And another thing you might talk about this is I was on a podcast yesterday, a Doomberg, which one of our members posted in the other topics. There's a link to this. It's like an hour and a half, but one of the things he talks about is data centers also need to be kept very cool, very cold if they can, because those machines, they get real hot. The more data they're generating, the hotter they get. So they're going to either have to put massive air conditioning on these facilities, and they're as big, they're giant, they're as big as a football field. These buildings to house all the computer processing equipment, and up in Canada, hell, you just open the windows. In the winter, the cooling will be free.
I'm glad that it's finally we have an advantage to the cold weather that we endure. It actually applies to our LNG facilities too, because when you're cooling gas down to minus 160 degrees, which is what they have to do to liquefy it, it's a lot easier to do that in northern BC than it is in the Gulf.
Now they're also talking about building them in Canada or in Alaska.
Yes, they are.
I just heard that yesterday.
Yeah.
Anyway, hey, LNG Canada phase 1. Okay, its design capacity is near 2 BCF per day.
Right.
How are they giving any indication about how fast they're going to ramp up to that?
Yeah, so they are. We watch closely kind of what the United States experience has been, because you've had multiple chains ramp up. The Plaquemines one is a tremendous one, of an example of how fast it can happen. Right now, most analysts out there are thinking that it's probably going to be about a BCF a day by the end of this year. So in the next few months, that they'll ramp up to a BCF a day and then get to the full capacity of 1.9 BCF a day in 26. And as I mentioned earlier, the piece that we're all waiting for, our industry, is, are they going to announce that they've gotten a positive financial investment decision, so FID, on phase 2? And because they've already built phase 1, again, we've seen the example in the United States, it's a lot easier to add trains once you've already got the base set up. So the view is that they maybe can bring on the next 2 BCF a day within the next couple of years. And so that, hopefully we'll hear more from it. Shell and Petronas are the two main partners in the LNG Canada. They both have been pretty vocal that they want to build phase 2. Matter of fact, if you go to the LNG Canada website, you'll see a really interesting kind of a walk through their facility, and it shows both phases in operation. So clearly everybody's working for that. The pipeline capacity, they don't have to build a new pipeline. That's key to go to the second phase. They already have the pipeline capacity. So we're hopeful that in the next few months, we'll hear something out of them that they're going to go to this phase 2 now that phase 1's operational.
Yeah, and I think once they announce that, you'll see the futures prices in Canada going up.
I agree with you. I think that's when
you'll be able to hedge more gas at $4 or something.
I agree with you. That's our view as well.
Okay. Does Pine Cliff now have enough liquidity to fund your second half drilling program and still maintain the monthly dividends?
Yes.
Okay. In your core areas of operations, do you have annual drilling requirements? And somebody did post a question here about how much of your acreage is HBP'd or held by production.
Yep. Terry, you want to take that one? You have to come up.
Sure, you bet. Thanks, Phil. Thanks, Dan. With regards to annual drilling commitments, we really don't have any annual drilling commitments, certainly for the next few years. And so the vast majority of our acreage is held by production. So good. I know on the inventory slide, on slide 9 of the presentation, we talk about all of our Glauconitic locations, Ellerslie, BQ, and Pekisko. Those are all held by production with no near-term drilling commitments required on any of those to hold the acreage. And I think, Phil mentioned it earlier, and I think of, in particular, our Glauconitic formation, or our Glauc oil formation. We've got 25 gross locations, 18 net locations, and the team has done a fantastic job cobbling together those locations. When we did our acquisition in December of 2023, the Glauconitic locations, these are the 2-mile Glauconitic locations. We had 2 gross, 2 net that were operated and drilled. And through a combination of swaps, exchanges, renegotiations with various third parties and mineral interest owners, we were able to get 25 gross locations and 18 net locations cobbled together around our own high working interest, essentially 100%, 99% working interest infrastructure. So the pace of development is really in our own court, so we can decide how fast or how slow we want to develop those locations. And we're just signed off the offtake agreement, so we've got lots of capacity to process the volume. So you know, again, the drilling inventory is really at our discretion. And
So when are you going to start drilling out here, and how many wells in each one of these areas are going to drill this year?
well, we're going to focus on the Glauconitic this year is most likely where, you know, probably, you know, again, when we look at capital allocation, and Phil talked about it, it's obviously you want to hit the highest rate of return, but also risk comes into play. So Glauconitic, and risk is both geological risk and execution risk. So Glauconitic is probably our primary target later this year, and that's where the vast majority of our 2025 capital program would go. But I would suggest the Basal Quartz would be a close second. And, you know, as we get into 2026, probably would be a combination of Glauconitic and Basal Quartz. And then the Ellerslie Formation itself, we've got 27 gross locations identified. There could be significantly more, but that's kind of an emerging play. It's a little bit higher risk for us at this point in time. So I think, you know, the near term is going to be mainly Glauconitic and Basal Quartz wells. And probably years 3 to 5 is when we might start thinking about developing some Ellerslie. A lot of it you know, the pace of development is really going to depend on cash flow generation and capital allocation. But I would suggest, you know, in a fairly normal commodity price environment where we think we're going into, I would think we would be somewhere between 3 to 6 wells per year, combination of Glauconitic and BQ for the near term.
But so this year, by year end, you think you'll have like 3 more net wells online?
No, probably just 1 Glauconitic. They're higher capital cost, but they are fairly significant. I mean, we've got the IP 365 at 1,266 BOEs a day. So just for clarity, that's the average initial production for the first 365 days. So they will come on significantly higher than that. You know, it depends on the location but you know, it's probably closer to 1,500 to 1,800 BOE a day, 50% gas, 50% liquids. So the plan, Dan, would be to have 1 Glauconitic, 1 net Glauconitic. It could be 2 gross, could be 1 net, depending on how we work through that on production by the end of the year to come, you know, try to take advantage of Q4 pricing. So,
and who are your industry partners out here?
We've got a variety of them. You know,
You're the operator on these. You're the operator on all these.
Yes, we are. Yeah,
okay.
We've got right now we've got surface locations and pipelines acquired or in the process of being acquired for up to 5 Glauconitic wells and up to 4 Basal Quartz wells. And again, the flexibility we have is you negotiate these agreements with surface landowners and make sure we've got the appropriate mineral interests. And you negotiate those ahead of time so that we call it drill ready. So those locations are all drill ready. And when we decide the time is right for us to execute, we can execute on that program. So this year, like I said, just from a capital allocation perspective, the Glauconitic is our main target this year. We're targeting to have at least 1 net Glauconitic well down by the end of the drilled, completed, and on production by the end of the year. And then in 2026, we'll just see how cash flow goes and assess our level of activity from there. But we will have lots of flexibility. And the key again, Dan, and you nailed it, is these are operated wells that we can drill at the pace that we dictate.
You decide.
I think the only thing I'd add there, Dan, is that, you know, for your NAV listeners and people who really like to drill into the reserve reports, I mean, we've got $180 million of NPV just on the Glock wells. That's for a company of our size. And again, I don't expect anyone to have been giving us credit for that because we haven't been drilling them. we acquired these, all of those locations were acquired in that December 23 acquisition, and we haven't touched them yet, but that's changing this fall.
Yeah, so this well could, add more proved reserves and 2P also, right?
Yeah.
Yeah. Let me ask you, do these areas, are they limited, like with the spring breakup? You can't get in there for a few months every year?
Typically road bans come on during spring breakup, so you're limited by what you can and can't do. So usually that's probably, depending on the area, a month to 2 months, but we will definitely work around. The vast majority of our locations are all season access, with the exception of probably 1 to 2 months. So it's not, some of our, not ours, but as a
But
base.
it's not gonna impact this year's drilling program at all, right?
No. And I noticed one of the other questions that came up, and it's key to us, is to try to get these drilled before winter hits, because it keeps the cost of drilling down, and the services are quite a bit more plentiful if we can drill them in October, November. Costs will be less. You don't have to worry about winter operations with boilers, extra fuel, and the cost of services and the availability is much, much better. So that's one of the goals, is to get our Glauconitic well spud before winter and get it completed and on stream before winter, so we can take advantage of a little bit better weather and drill it and bring it on production in a higher commodity price environment.
Well, I worked for Hess for 18 years, and we always wanted to get our North Dakota Bakken stuff all completed before Christmas, and then not do anything, because it was so much more expensive to, do the rigs, the heat the rigs and everything in the middle of winter. Anyway, okay, let me see what drilling commitments, slide 9. I think you mentioned on slide 9. Yeah, we're on slide 9 right now. Okay, what oil and gas price assumption do you use in your PAL calculations? I think it's there at the bottom.
Yep, it is $60 WTI and $3 AECO.
And you saying the strip right now on AECO's for the fourth quarter is already above 3?
It is, it's right around 3 for the fourth quarter. But for these wells that we're talking about bringing on, will be in early 26, and it's over 3 for 26.
Okay, let's see. Let me get into the questions that I think we answered that. When you look to resume drilling new wells in the second half, when would you likely drill? I think you mentioned you're just going to get that one well on by the end of the year. What should be the time to drill? How long does it take to drill and complete these wells? They have the number of days on there?
Not sure we have the number of days, but they would be, notionally probably 15 days to drill and set the liner. And then, fracking operations and completion operations, depending on how it gets sequenced in, would be probably, 10, 12 days. And then tie-in should be fairly straightforward. We typically have the tie-in done and ready by the time the well is ready to be flowed. And I think, the key is, one net well, so it could be 2 gross wells. And the key distinction with that is, ideally you would like to drill these wells in pairs of 2, like more than 1, for cost of services.
Right.
Mob and demob costs can get quite high. So ideally it would be advantageous, and we're working on a few different plans to perhaps drill 2 gross, 1 net well by the end of the year. So there could be 2 wells come on, but lower working interest. Could be 1 well. We've got flexibility on how we want to do that. So we're just trying to kind of negotiate or navigate through what that's going to look like. So
these are, you build a pad, but from that pad, you can drill multiple laterals from that pad.
Yeah, bingo.
And is that there only one formation that's productive there? You have stacked pays or anything?
We do have stack pays. So the Ellerslie is prevalent throughout the area as well. So it's just not quite it. The results are a little bit variable. There's some really good Ellerslie wells that have been drilled. And I don't think that nut's been cracked just quite yet on the optimum drilling and completion technique on the Ellerslie. So that's why it's probably not anything that we would do for probably 3 to 5 years. Let the play develop a little bit more. But the Ellerslie is prevalent throughout the area as well. It's just the Glauc is highly prospective at this point.
Is Whitecap in this area?
Yeah.
Okay, I just started looking at Whitecap because Varen was one of my top picks heading this year, and they took over Varen. Merged into Whitecap. It's an impressive big company. I couldn't believe how little analyst coverage it has for the size of it. It was amazing. Anyway,
they've done some big acquisitions in the last couple of years.
Yeah. Okay. Let's see. What have drilling costs come down because of the, decline in the active rig count?
I would say they haven't really come down, but they haven't really gone up either. I mean, it's a quite a competitive market still. If AECO does truly, in fact, go to north of $3 as we expect it would, and oil, WTI hangs around $65 or $70, I expect that the basin will get very, very busy and cost of services will go up. But, right today, cost of services, are, I would say they're haven't gone up, haven't really gone down. They're probably pretty decent. And again, Dan, you suggested that. I mean, that's why we want to get these wells down later this year, or 1 or 2 gross, depending on how we do it. Get your activity done before winter. But also the other key factor in Canada is in winter, a lot of areas, not Pine Cliffs areas, but they're only winter accessible. So the drill rig count goes up significantly in winter, and so the cost of services go up in Q1. So we want to make sure we get our services done in Q4 and get our wells on in Q4 before those costs of services go up.
And especially for, small caps like you guys, you got to do it the most economical. I mean, it's great to have continuous drilling programs, but it's also better to have the best well level economics, and you do that when you have lower drilling and completion costs. How about steel costs? How about casing prices? Have they stayed pretty reasonable?
Yep, you bet. There's fair decent availability of it. We've scoped it all out, so it's not I guess, I mean, who knows tariffs and how that's all going to go, but we haven't really seen that major impact on it. And there is quite a bit of steel on the ground already, so
that's good. Yeah, one thing I definitely want to clarify for the people watching this, and I get this question all the time. Well, what about the tariffs? What about the tariff? People, there's not a 10% tariff on 90% of the oil and gas we're getting from Canada. So if it qualifies under some previous North American treaty or something, there's no, and so none of your sales are subject to tariffs, right?
Not at this time.
Okay, good. Okay, let's see. Okay, tell us about the deal that you have on the gas supply to that AI center. How is that? Is it you're agreeing to a certain volume at a certain price, or how is that structured?
Yeah, that's something we announced in January. We're restricted a little bit on how much we can talk about it, but in the press release we talk about volumes, and the current size is kind of up to 5 million a day. Is that right, Terry? I think is the right. So that would be about 5% of our production, ballpark of our gas production. The nice thing, as I mentioned earlier, is that the pricing is tied to NYMEX, so it's a good, nice diversification for us. And for us to get NYMEX pricing today, we would have to pay the transportation cost to send it across the continent. So you don't have to do that when you're just giving the gas into your backyard. Like this data center, it's contemplated that it's going to be built right on our land, and so we just supply the gas. We're only moving it, a few yards as opposed to across the country. So it's a very good deal. We haven't started construction yet. We are just the gas supplier to it, so we're not in control of the timing of the construction. But we are, we have talked to them extensively. We've talked about the potential of making it bigger than what we've currently announced. That's a possibility. We've talked about other sites as a possibility with them and with other potential data center developers. So we're pretty excited about that. That could be a real game changer, because like I said, it will turn some of our less profitable assets into some of our most profitable assets.
Yeah, I know. It's a big deal. You're turning, instead of selling it at the gas price, you're turning it into electricity.
Yes. Yeah.
Let's see. Do you like one of the companies I follow closely is Peyto, and I'm amazed by how they've locked in a lot of their gas sales at NYMEX. Is pretty amazing. But are you able to redirect your gas, like to market it to different locations to get better prices?
Well, you can always hedge and use
Yeah.
financial hedges to move the gas. We do that. About 10% of our gas production today, which is about 10 million a day, goes to the Dawn market. And the Dawn market is it's a eastern province. It's in the province of Ontario, but it's very tied to NYMEX and Henry Hub pricing. So we get that, but you're spending $1 an MCF to get it there. I mean, a lot of the companies they'll enter into very extravagant hedging, either financial hedges or take or pays. But there's a cost to all of that. And so they quite often, you're always curious what the net cost is and what their net, what they're actually getting in. And maybe Austin, maybe you can update the audience here on what our current hedging position is.
Sure. Thanks, Phil. Our Q3 hedges are about 60% of our gas production's hedged, at a number just over $2.90 an MCF.
Oh, good.
And Q4 is approximately 45% at $3 an MCF. So, as Phil alluded to earlier in the presentation, some of our production, we anticipated a little bit of volatility with LNG startup timing, et cetera, and wanted to get ahead of that. So, those numbers are a little bit higher than we normally hedge, but essentially it's based on that.
But you don't have much hedged for 2026. If you go back to one slide, I think you showed 2026.
About 30%.
Yeah.
So we'll always hedge out because we want to protect our dividend.
Right.
And we want to protect our drill program. So we'll always hedge out a certain amount of our production. And if, right as Austin mentioned, we knew this summer had the potential to have soft pricing because we didn't know when LNG Canada was going to start up and get going. So we hedged. This is the most we've ever been hedged. So we're, like, as he mentioned, the spot prices don't impact us as much because of our strong hedging position for Q2 and Q3. But going forward, you're right, Dan, we're about 30%.
Yeah. I think, weather demand is always going to impact the gas price. And
Correct.
I think, because we've had a very mild weather. I mean, here I am in Houston, Texas, last year we had day after day of 100.
Yeah.
Yesterday, I think the high was only barely above 80 because we've been getting all this rain. You've heard about the flooding in
Yes,
Central
of
Texas.
course.
A lot of it moved, through my area. We had massive thunderstorms for like 2 days in a row. It's moved out now, but it's really cooled it down, which is surprising for this kind of year. I just saw something this morning that said they're thinking the back half of January will heat up. I'm personally a believer in climate the same. I don't think there's any climate change. I think that the heat and the cold moves around the planet, but the planet, it's just where it is. So for us, if we get the heat over the eastern half of the country where everybody has, that runs their air conditioning 24/7. Down here, that's me most of the time during this time of the year. And that draws a lot of electricity. It takes a lot of natural gas to keep those electrons going.
Yeah, I do I should mention this to your listeners. I do a quarterly email that I send out. It's a free subscription. And I had focused on that point. By the way, you can sign up for it on our website. But the amount of air conditioning, this is a real big issue globally. India, that is now coming out, they're doing the same thing China did, where they're adding a lot more people to the middle income. One of the very first things they want is air conditioning,
Right.
So the amount of energy that's going to be drawn globally because of the air conditioning demand that's rising in Africa and in the Asian countries is really significant, which again is driving the natural gas demand globally.
Yeah, it really is. And I actually am giving a presentation in Philadelphia, believe it or not, on next Wednesday. And one of the slides I have, it shows the energy per capita that's consumed in India and China. And in India, which is now, has almost as much population as China.
Yeah.
They're still less than like 8% of the energy that Americans consume per person.
Yeah.
And like you said, what they want, and not only that, a lot of the areas in India don't have electricity 24/7.
Correct.
So, when they get electricity, they want a refrigerator.
Yes.
It stays cold all the time. They want an air conditioning unit in the window, and it's going to really ramp up demand. And the only way and they're looking at unless they want to keep building more, coal-fired power plants, it's going to be natural gas-fired power plants. So the outlook in the next couple of decades is unbelievable for natural gas, really.
I agree.
What could you elaborate? What scenarios would Pine Cliff would have to find itself in if for you to issue more equity?
You know, the I'm not the deal I've got with my major equity shareholders like Aimco and George and some of the others is that I'll never ask them to write a check for equity unless I'm willing to write one myself. That's kind of been the test. I think if we were to do another major acquisition, like if we were to do one of the size, if it's 100 or 200 million dollars, we probably would need to use equity. We're always looking at things. We can do smaller tuck-ins, $10 million deals or $20 million deals where we don't need to issue any equity. We had zero debt and we were sitting on $50 million of cash for about 2 years until we did that December 23 deal. So we used up our cash, we put some debt on, we're paying down the debt. We're always looking at transactions. If there was a transaction that was accretive to us as shareholders and made the team is sick of me always saying does the deal make our shares more valuable after the deal? Yes or no? That's the test we use. And if the answer is yes, then I think we can be a lot more. I think our reach is longer than what people probably believe because we haven't used equity a lot, even though we've had very good valuations. I think our ability to, I think we could raise equity today, even though it's a very difficult market because we have a very unique shareholder base and they like what we're doing. But they know that I'm not going to come to them with an equity request unless it's a very good deal for us. So if it's a transaction that makes a lot of sense to us, it makes us a lot stronger, that is something we would consider issuing equity for.
And another thing, if the gas market up there really firms up, there might be sellers that would be willing to take your equity.
I 100% agree with that. And we talk to those guys. I mean, if you've got an asset right now that's natural gas, if you don't have to sell it right now, you're not going to sell it right now.
Yeah,
Because
right.
the prices are
you're selling at the bottom. So
exactly. So you're going to wait till 26 when prices are $3. Okay, now that's reasonable. And if you're a bull on natural gas like you and I are, you might say, we'll take stock because we want to ride.
Yeah, right.
We want to continue to ride this. We want liquidity, but we don't want out.
Yeah, I tell you, I really prefer companies, small caps, if they're doing acquisitions with 50% debt, 50% equity, because what that tells you is the seller is willing to take your equity because he believes in the asset.
Right.
Right. He believes in the upside of gas price. He believes in the upside of the asset he's selling you. So that's always a positive sign. So let's see, you mentioned AECO could rise with LNG Canada exports. Do you expect AECO pricing to converge towards NYMEX as more West Coast export capacity becomes online? My answer to that is yes.
I agree.
But you need to always take into consideration the transportation cost because you're going to have the transportation cost to get it to your West Coast or to get it into the U.S., right?
I 100% agree, Dan. And one of our one of our best persons for our industry up here is Mike Rose, who's the CEO of Tourmaline, and which is Canada's largest natural gas producer. He's been very vocal that he believes that differential is going to squeeze in the back half of 25. So in the next few months.
Yeah, in the next few months, I think it will.
Yeah, because as LNG Canada comes on, there really is no good reason why AECO should be at that wide a differential to NYMEX Henry Hub. It should be the cost of transportation should be roughly what the differential is.
Yeah. Well, I'm probably just recently, I raised my gas price forecast for the U.S. To 425 for the third quarter. I'm probably going to have to reduce that. I just did this like 3 weeks ago, and then 475 because our strip prices, we had $5 US in January, February of next year. So the January NYMEX contract at the end of November will be the front month contract. That'll be the price you see in the news every day, and it's sitting right below $5 today. So if you have $5 gas in the U.S. and you guys come up, maybe take it down, you could be looking at $3.50, $4 gas here in like 6 months. I think if you just get it.
I mean, your listeners probably aren't aware of this, but this webcast is kind of the kickoff of our marketing campaign for the back half of this year, of which I'm going to be on the road a lot because I think exactly what you just said. I think this fall, winter is going to be a great time to be talking about natural gas, given all the LNG coming on in both Canada and the United States, given the data center growth is we're starting to see that now seep into natural gas demand. Our own drilling program, there's a lot of catalysts, if you will, that I think it's a good time to talk natural gas. And I think there'll be a lot of people talking about natural gas and AECO pricing and NYMEX pricing and LNG. These are all going to be pretty topical in the next 6 months here.
Yeah, and you know, the thing I think, and this was on the Doomberg podcast that I watched yesterday, and his comments were, you know, that oil prices are set on a global market because it's really easy to ship oil by tankers to wherever the best prices are. Well, once we get North American LNG export capacity up to 30, maybe 40 BCF total with Canada, Mexico, now you're talking the utility companies in the US are going to be competing with the LNG exporters for physical supply. And it's going to go, you're going to be selling their gas to the highest bidder kind of thing. And that's what it is in the oil market. I actually had lunch years ago, 5 or 6 years ago with API when we were just starting to build these natural gas export facilities. And the talk around the table was once we got up to like 10% of our gas was able to be exported, they said our gas price will move toward the international price, which is based on the energy content. So the reason that the gas price in Europe and Asia is $10, $12 per MMBTU compared to our, $2.50, $3, you'll start moving that. And it's like, if I start putting $4 and $5 gas prices in my forecast for next year for the company review, Peyto, Whitecap, the numbers are incredible. How all that falls to the bottom line.
Yeah, we try not to get we focus on we're very conservative. But you're absolutely right. I mean, the number, like I say, every dollar move is for us is about $35 million of cash flow, $33 million of cash flow. So those are big numbers, a lot of free cash flow. I agree with you 100% on the the one and I've listened to the Doomberg as well. The natural gas. The difference, one of the big differences between natural gas and oil is that oil is easy to move. You can put it in trucks if you have to. You can put it in trains if you have to. Natural gas, why there's always a lag between supply and demand is because the only way to send natural gas, you have to spend a lot of money. You either have to do LNG, so liquefaction, or you're going to have to build pipelines. So either way, there's a time lag and a big, huge capital cost to move natural gas because you can't just put it in trains and put it into trucks like you can with oil. So, but that capital investment is happening as we speak around LNG and around the pipelines.
And around the AI data centers is the same thing.
Correct. Which is why they're building these data centers right closer to the source of where they get their energy.
Yeah, and believe me, they know what's coming on the energy prices.
Yeah.
And they get this. So a year and a half ago, I was the opening speaker at this big energy conference up in Dallas. And the guy that spoke like 2 after me and his presentation, he shows a slide of Virginia. And he said there was 25 data centers to be built in the state of Virginia that were going to get their gas from, Appalachia, Marcellus, Utica gas, right? And, I'm thinking, and then he said, those 25 data centers are going to need more electricity than New York City. And I said, buddy, that's a lot of electricity. And you're talking a lot of gas.
Yeah.
And I don't think the Marcellus gas could ramp up that much.
Yeah.
So I think when they all sit down and start looking at it, they go, not only can we not build them near the big cities, we have to build them near where the gas supply is. And that's why I think a lot of this is switching. You just can't do it. And if you go back to that slide where you've got the Antero one where it shows the 29 BCF growth or whatever, the problem I have is because I actually think Appalachia, Marcellus, and Utica may be nearing peak production anyway, no matter how much pipeline they have, but they're pipeline constrained to some extent. The Permian Basin gas is cheap because it's pipeline constrained. So the places that can grow that fast are maybe the Haynesville with South Texas, where you got Eagle Ford gas, but Eagle Ford gas is deeper, it's more expensive. Maybe a little bit in Oklahoma, but you need higher gas prices before everybody's going to drill baby drill out there. It's not going to be happening at 3 or 4. You know, they probably maybe need like 5. So to keep up with that level of growth over the next 5-6 years, the infrastructure has to grow. Pipelines, processing facilities, compression, all that has to be built. And it's going to require a higher base price to make the economics work. And that's just the deal of the whole thing. So anyway, I'm kind of going over time here, but let me see if there's one more question here. Would you consider tapping debt to maintain the dividend in a weak commodity scenario, or would you prefer lowering the dividends?
We will lower the dividend.
Yeah.
We were tested on that in March. And again, we're big shareholders. Anyone making the decisions at the board level, at the management level, we own a lot of stock. And so we never felt it was sustainable to use debt to keep the dividend going, which is why we reduced the dividend in March. We could have kept it going with debt, but I don't think we don't view that as a proper way to run the business. We are now heading into an environment where we're generating a lot of free cash flow. Definitely one of the things we'll be talking about in 26 is, do we raise the dividend at all?
That was the next question I was going to ask. If gas firms up at like $3, $3.50 Canadian, will you be able to put your dividend back to where it was?
I'd like to start to move it back up. And we're watching really closely some of the US models on variable dividends, flexible dividends. That's something that's attractive to us. We typically have not done share buybacks, and the reason for that is quite often we trade at 4 or 5 times cash flow. If we can keep buying assets at 2.5 or 3 times cash flow, it doesn't make a lot of sense to me why we'd buy back our own stock if we can go buy good assets for less. But the dividend, I think that our goal would be start to move the dividend back up as free cash flow continues to grow.
Yeah, and the thing is, your stock prices, if let's say gas prices go up, so now your PV10 net asset value goes way up. Well, the stock price is going to go up, or you're going to be acquired by somebody.
Right.
I did this for Hess. We closed $3.5 billion worth of acquisitions because we found public companies that were trading way below what we believe with their valuation. And especially if you hold a bunch of acreage, that's another point that is so important. If a lot of your acreage is held by production, that makes it very attractive to the large caps.
Yeah. And ours is, as Terry mentioned, we've got over 2 million acres. We have very few expiries each year. It's very nominal. Almost everything's held by production.
Yeah. Okay. Well, I think we got to end it here. Man, great discussion. It really helps me understand the Canadian market, gas market myself. I follow a lot of Canadian companies. We've actually, since I formed Energy Prospectus in 2003, it's now my hobby job. I can't figure out how to retire. I'm stuck with this job now. So anyway, we'll get you down here sometime to meet with our group. It's always good if you
I'd like that very much. I enjoyed today. Thank you for doing this. And if anyone's got follow-up questions, they can send them out directly to us.
Yeah, and if any of you are not EPG members and want to become members, just send us an email to energyprospectus, one word, @gmail.com. That's energyprospectus@gmail.com. And Sabrina, who handles our membership services, she'll send you a link on how to join. And our main goal is to help people understand the industry, and also we share ideas, and we have a lot of very intelligent people with a lot of industry experience in our membership, and they help me a lot to find. Like one of them referred Pinecliff to me. That's how I found out about it in the first place. All right, thanks a lot, guys. Wanted to hear, and we'll send you the replay link right away this afternoon.
Excellent. Thanks a lot, Dan.
All right, take it easy.